Reggie, several viewers have asked me to ask you this question. I don't know if I'm putting you on the spot, but it's an interesting question. Walk us through how the daily reset actually works. Some viewers are actually befuddled by how that works. So we have this daily Tesla bull, 1.5 times shares ETF, the TSLL. It gives you 1.5 times Tesla on a daily basis. What actually happens at the end of the day during the reset? What gets bought and sold? The viewers, several viewers have asked me to sort of, can you explain what happens in the reset?
Well, to keep it as simple as possible, there's a swap that is utilized to give the leverage effect in all ETFs, and then some counterparties. Some ETFs have 5 different swap counterparties to reduce the risk to individual investors if there's some sort of corporate risk to the swap counterparty. Remember, when some of the banks had an issue, their credit wasn't good, and the swaps they were issuing became at risk. So there's swap counterparty risk here, and so the leverage ETFs, they are backed by a swap, and the strike price or the cutoff period is the ending of the leverage, and then the ETFs are still trading after the cutoff period, where the swap is struck and reset, and then this ETF has a gamma effect or another derivative effect of how they're trading. So it's important to understand, 1, read the prospectus, 2, understand when is the cutoff time, when does the leverage stop, and then, and this is not necessarily meant to be a long-term holding, and so there's a reset. You're getting the daily exposure return of the underlying asset, and at the end of the day, it resets, and then it starts again the next day.
Right.
So it's meant to be held for 1 day, and if you hold it over a period of days, you're getting the reset effect, and you're getting another derivative called gamma, or where it's resetting inside of it, you're not getting the full return. So it's important to understand, 1, when is it reset? What are the periods not covered? And then the next day, what happens? So it's important to understand these important factors. Now, Will Ryan can accurately describe how he built his products, and when does the cutoff period begin, and what happens after that.
Well, thank you for that, Rich. I knew you'd do the answer. And I'm sorry, folks. I know that was a little wonky, but people were asking. So here's the question. Swap counterparty risk. I mean, Gensler's worried about this. I'm trying to figure out, is this some weird fantasy of his, or is there something? Is there some way that somehow a swap counterparty risk could translate into some effect on the underlying stock, or even some systemic risk in some way? I'm trying to get out what's the worry here.
Well, if you're talking about counterparty risk, which is obviously a valid concern when you're talking about a swap, which is a bilateral contract between 2 parties, the risk is whoever the counterparty is, typically is an investment bank. If they go bankrupt, then that will affect the value of the ETF. Now, obviously, we saw this during the financial crisis with Lehman Brothers, and there were a few exchange-traded notes that were issued by Lehman Brothers that were canceled or redeemed as a result of that, so people lost money. So that is a concern. But again, go back to the points that I think have been mentioned by Dave and Reggie, that these are designed really to be held for short periods of time. So if you're holding for a short period of time, typically counterparty risk is not going to be like one of the highest sort of levels of concern here, because you can trade in and out of it.
Yeah. Reggie, I'm just curious about what you think about the type of single stock ETFs, or the names that have been issued recently. So we have these Tesla ones we've been talking about that people are interested in, but I wonder how much demand there is for some of these other single stock ETFs out there. I mean, we have them for Pfizer, we have them for Nike now. Does anyone really need Pfizer single stock leverage and inverse ETF? We have them for PayPal and NVIDIA. Maybe there is for NVIDIA. I can't help but think, I want your opinion, will interest in these things coalesce around the high beta names, which kind of makes sense to me, or are we going to have hundreds or thousands of low volume single stock ETFs out there?
Well, fortunately, the markets are efficient. There'll be winners and losers, and issuers will not leave a product in the marketplace that's not getting reception by gating assets. So do you need to have a levered ETF on Pfizer? Probably not. Will you need it on Apple or Google? When I say need, will they be desire to have it? Probably. So these products are meant for daily returns, for daily exposure. And so generally, stocks that have high conviction, high beta, high volatility is where you'll probably see the most success in a levered or inverse single stock structure in the marketplace. And I'm a little loath to call it an ETF because we're starting to get into innovation that is broadening the ETF industry. And this is a good thing. It's bringing more investors into the marketplace. But having a clear view on investment tools versus trading tools as we go further into innovation is probably the best practice that we can put in. I say we, the ETF industry. Some sponsors have been talking about this for a couple of years. And as we see more innovation like this, I think it's probably the best case.
Yeah. Dave, what's next? Can you give us some insight? What other single stock ETFs are coming? What are you working on here? Everybody thinks there's more of this.
Yeah, again, we're encouraged by the early success and early interest, both particularly from a trading volume point of view in our initial launches, especially around Tesla. And as I've noted before, we have filings for other securities, particularly some of the mega cap names that you're going to see. Again, we're talking about names, in the case of Tesla, almost $1 trillion market cap. In the case of Apple, approaching $3 trillion in market cap, the largest security in the world, the fourth largest security in the world. So I do expect to see further innovation here, further filings and launches in the space. We're really at this time focused on, again, those larger names that have depth of volume and liquidity around them, so that we are in the best position to both create ETFs and manage them, in this case, as daily trading tools.
Well, as I knew, he wouldn't tell me any names. Of course not. But so the logical names are, semiconductors, even the high beta oil names. I mean, every day, if oil's moving, I could tell you a half a dozen oil names that are moving twice. If oil's up one, they're up two. Yeah. Or down. I mean, I could do this. In fact, let me do this. I'm going to leave. You take my job. I'm just kidding. So, help us out. Where's this going?
Yeah, that's true. Look, I mean, a part of it is obviously, as Reggie said, we've got to bring products to the market that, number one, customers want, and then number two, that are commercially viable. So the answer, or the question we always get asked is, can you do it on GameStop or can you do it on AMC? And the question so far, the answer has been it's been too volatile. So we can't provide a consistent level of leverage over time.
So there's actually a level where it's too volatile for you to, and under what circumstances would that be a problem?
It goes back to the rules that we are under in terms of the regulatory rules and how we can launch products. So why we have the different, what we call leverage factors, so the 1.5 times or 1.75 times. And so there are stocks that are just too volatile that wouldn't be able to compute with that rule. And so we wouldn't be able to offer those because it's consistent leverage. And again, going back to the reset, the rebalance, you're reinvesting those profits every day at the rebalance at the end of each day. And so sometimes there are stocks out there, there are any instrument, commodities the same, they're just too volatile.
Yeah. That's a great answer. Thank you. I appreciate that. And I didn't think about the fact that it would be too volatile. Now, folks, I want to thank you. We had a fascinating discussion. I know we got a little wonky with Reggie there, but that's why we have Reggie, because, he's the expert in this stuff here. Now, that does it for this week's ETF Edge. My thanks to Reggie and Dave and Will. Now, we've asked Reggie to stick around and be even more wonky, give us his wisdom on ETF trends for the second half of the year for our ETF Edge podcast. That's coming right up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.